Would you like to know how to turn £50,000 into a £1 million portfolio? Well, don't go anywhere, because that is exactly what I'm going to run through today. I'm going to be talking about how you should invest with the right approach, how you need to leverage debt to build wealth, the best ways to invest that £50,000, the key concept of compounding that you need to understand, and how to use other people's money effectively to meet your goals. So the first thing you need to do is be strategic with your approach and your £50,000, because relatively speaking, in the world of property and investing, £50,000 isn't going to get you very far. So you need to be really careful with that money and be very considered about where you spend it. The best approach in order to maximize your capital is to target high yielding areas and high capital growth areas, because that will, one, increase your returns, and two, increase the amount of equity in your portfolio over time. So you need to research where these areas are, but often, particularly around yields, the best yields in this country are in the north, where you can get potential yields of 8 to 11%. This is because the property prices are relatively low and the rents are kind of comparatively high. So for example, in Sunderland, for example, where we invest, you can get a property around £90,000 and you might get a rent of £650 a month, which is a really good yield, especially compared to the south. So you want to look at yields above 7%. You also want to target areas where you can purchase a property for 110K or less. That's because that's where the sweet spot is in terms of the yield. But also you can make your capital go further by picking these kind of lower value areas and higher yielding areas. And another way to make your capital go even further is to buy below market value. So that's where you buy a property which is below its comparables in the market. So you might have a property on the same street which is to a really good standard, but you're buying one that's slightly average standard. Your property's at 90,000, but the one that's to a really good standard is at 100K, for example. So you're buying something that's 10K below market value, and this means that you're already building in some equity on day one, which will then help to compound and grow your portfolio over time. Even if you buy a property which has only a few percent below market value, so say 3% below market value, you're still building 3% equity and added value into your property portfolio, which will compound in the long term. So let's look at some example numbers of your first property purchase in this portfolio building exercise. So you're going to purchase a property at 100K. You're going to have a mortgage of 75% loan to value. So that means you're putting down a deposit of 25%, which is 25K. Other costs involved in this purchase are stamp duty, finance fees, such as broker fee, and if there's any admin fees from the lender, valuation fee and survey fee and legals. And all of that equals £5,200. And then this property needs a refurb of £10,000. So all in all, your capital outlay equals £40,164. So you're actually buying this property below market value. So the property has an end value of 115. So you're buying it below market value by 15,000, and that's something that you can unlock once we come to refinance in the future. And obviously you're doing a refurb on it already. So the property will be a buy to let. It will be rented out at £675 per month. And that will give you a net cash flow after cost of £200. And that's based on a 5% interest rate. And I made some assumptions here in terms of how this then grows. We are making the assumption of 5% growth per year, and that you're going to refinance the property at a key point, and then you're going to release more equity to buy more properties, and you're also going to reinvest the rental income back into this property business to let it compound. So now in order to maximize the returns and benefit from the power of compounding, we're just going to do nothing. We're just going to let that property sit there and earn its rental cash flow every month and grow in terms of its capital appreciation over time. Because this is where the real returns come in property. It's over the longer term, and we just need to be patient now and let that property do its thing and let the magic of compounding do its thing. So we're actually going to leave it for 13 years, which is a long time, I know, but as I said, you need to be patient with property, and it is a long-term venture, so you need to just trust the process. Now you might be asking, well, why can't I do anything? Why can't I take this additional cash flow that I've got, the £200 a month that I'm getting, and save up and go for a nice trip to Barbados? That would essentially be undermining the process, and it wouldn't allow you to turn your 50k into £1 million if you kind of disrupted the process and did something different. And this is because it's all about the compounding and the power of compounding, and this is why Einstein said it was the 8th wonder of the world, because it is such a crucial concept to understand. Although it's difficult to understand in the short term, the real wins come in the longer term, over that 20 to 30 year horizon. So let me explain about compounding. I'm sure you all know the story of the king who offered his two sons a choice to inherit his wealth. They said, you can either have £1 million tomorrow, or I will give you 1 penny each that will double in value for the next 30 days. You have 24 hours to decide what you want to do and let me know in the morning. So one son ran off and said, I'm definitely going to take the £1 million. And the other son thought about it and decided to take the pennies. And I'm sure you've all heard this story before, and I'm sure you all know how it ends, that the brother who had £1 million only had £1 million after 30 days. But the brother who had the penny that doubled every day, although that doesn't sound very much at first, and it isn't for the first sort of 26 days, he still hasn't actually got a significant amount of money. But the real magic happens in the sort of last 3 to 4 days. At the end of that 30 days, he actually accumulates £5,368,709 from that 1 penny doubling every day. And as I said, even on day 25, it's not even anywhere near the million mark. And you have to imagine this fable and this example and think about it with your own portfolio and the example that we're talking about, because this just really demonstrates the long-term viewpoint that I'm trying to kind of hammer home here, and the long-term horizon that you need to be thinking about in investing, and thinking of that in terms of the penny exercise, that those last 5 days are the equivalent to maybe the last sort of 5 to 10 years at the end of your investment cycle. And that's when the real magic happens. It's in that last 5 to 10 years on a potentially a 25 to 35 year horizon where the real growth and the real wins happen in investing. And unless you're patient enough to hold on to 25 years or 30 years, you're not actually going to see the real benefits of compounding and investing that will then lead you to the wealth that I'm sure you're looking for. And that's why we really need to recycle the cash flow that you're getting every month back into this deal to ensure you're getting the long-term compounding and maximizing your returns into the future. I'll let you into the secret. The main way of turning £50,000 into £1 million portfolio is actually really a slow and long game. It is really a lot of waiting around and very little action, which I'm sure will surprise you, because I'm sure you thought this may be a lot about going to find out lots of deals and running around and doing lots of trading and deal making, and in fact it's the opposite. It is a lot of sitting around and not doing much. And think of the prince who was patient enough to wait for 30 days for his pennies to double to end up being 5 million. You need to be patient and wait for the power of compounding to happen. So now we're going to wait 13 years. So at the end of year 13, this will be the current status. So you have one property which you purchased in year 1. It will be now worth £206,000, 528, based on that assumed 5% growth per year. So that means the capital appreciation in that period has been 91,000. You've accumulated all of the rental profits as well, and that equals 31,200. So what you're going to do is you're going to refinance this property at £206,000 value. You're going to do it at a 75% loan to value. And that means 206K times 75 times 75% gives you a deposit of £49,000. And then we have to take off the initial deposit of 25,000, which means that gives you an uplift in value to put towards the next property of £24,000, your deposit of £24,000, and then you plus the 31,000, which is your rental profit. So that means you have capital available of £55,000 capital. And that means you can purchase your new property. As the same before, we will purchase a property at 100K, and the capital required for that property will again be 40,000. So at the end of those transactions, you'll then have two properties with a portfolio value of 321,523, which is not a bad start from a £50,000 investment. Hi guys, if you're enjoying this video today, please can you subscribe to the channel, because we're trying to grow it and get more content out to people like yourself, and I'd really appreciate the support. So you're going to again wait to 7 years. So now we're at year 20. You have two properties, remember? The property number 2, so I'm going to call that P2, is now worth £161,000, and it has a capital appreciation of 46K in that 7-year period. You're going to refinance it at this higher value, and you're going to use this capital here plus the rental income that you've got, so the uplift in the value plus your rental income, to then purchase property number 3. And property number 3 is going to be purchased at 100K again, same as before. So you now have 3 properties at the end of year 20, and your portfolio is worth £567,416. We're now going to wait another 6 years. So now we're on to year 26. You have 3 properties in your portfolio. Property 3 is now worth £154,000. It has made £39,000 additional equity through capital growth. You're going to again refinance that property at the higher amount on a 75% loan to value, which will give you a deposit of £38,000. You'll use the rental income again to purchase a new property. So you're going to purchase property number 4, and you're going to purchase that again at 100K. So now you're on, to recap, you're on 4 properties at the end of year 26. You have a portfolio of 871,683,000. And I think it's worth looking at what are the values of the other properties in your portfolio. So you have property 3, which you purchased 6 years ago, is now worth £154,000. You have property 2, which you purchased in year 13, so 13 years ago. That is now worth £216,000. And property 1, you purchased 25 years ago, and that is now worth £385,000. So now we wait again, and now we're in year 30. And we haven't done anything, but you now have 4 properties with a combined value of £1,029,377. So you have reached your goal of having a £1 million portfolio from just 4 properties, from just that initial investment of £50,000. So to recap on the values of all of those properties that you now have, and we've taken very little action. We've done a few refinances and a few purchases, but it's the time and the power of compounding that's actually brought you the wealth. So property 4, which you purchased only 4 years ago, is now worth £139,000. Property 3 is now worth £187,000. Property 2 is now worth £251,000, and property 1 is worth £451,000, and that equals a total of 1,029,000. And that is the magic of compounding and how you turn 50k into 1 million. So there we have it. That is how you turn £50,000 into a million over a 30-year period. Yes, it's slow, and yes, it's steady, and you have to have a lot of patience. And of course, there's a lot of other ways to accelerate this, to make it less than 30 years by inputting more of your own money into it, for example. So if you had some other savings from elsewhere or accumulated some savings or some inheritance, for example, you could put that into the pot to accelerate yourselves towards that million and make it quicker than 30 years. Or you could potentially partner with other people and buy property together, which again would get you to that destination sooner. But of course, that wouldn't actually be turning £50,000 into 1 million. That would kind of be cheating, but I just wanted to give you this example of £50,000 into £1 million portfolio to show you how it can be done. How it can be done with kind of very little action. You're actually only buying 4 properties across that 30-year period. All the hard work's actually done by compounding. And the other kind of key point of this example is the long-term nature of property and how you should be viewing it all from a 25 to 30-year horizon. And also how you need to have patience. The best approach in property is to hold and to wait for the long term and to let compounding do its thing. And then you can turn £50,000 into that £1 million portfolio without having to do very much. Guys, you know what to do. It'd really help us if you could subscribe to the channel. It'd make a real big difference. So thanks in advance.